Thank you, everybody, for coming out. I know it's a cold Thursday night here in Chicago. I appreciate you coming out to spend the evening with us. We are 10 West Real Estate Group. This is Sips and Strategies, okay? So we're going to have some hurricanes, and we're going to talk about real estate investing, okay? We're going to go through the basics, try to give you a framework for real estate investing. I'm going to cover a lot of material today. Don't worry about it. You'll have my contact information. If you need something, reach out to us. We'll get this presentation out to you. So don't struggle trying to read what's on here, okay? We'll get that out to you later. All right, so who are we in front of you? Who's going to be talking to you for the next hour? I am Jim Marzullo. I am the founder and CEO of 10 West Real Estate Group. We operate about $175 million worth of multifamily real estate in the west suburbs of Chicago. My wife and I are personally invested in about $45 million. So we own and operate our real estate. I am a former home builder. I was the president of the Home Builders Association of Greater Chicago here in Chicago. But I spent the first half of my career as a tech entrepreneur. So most notably, I had a tech startup business that I sold to Grubhub, and then I ran operations for Grubhub up until they IPO'd and became a public company. I'm going to let Nick over here introduce himself.
I'm Nick Shop. I'm a senior associate focused on acquisitions.
You can share if you want to.
Focused on acquisitions and asset management here at 10 West. I graduated from Indiana University with a degree in finance. Go Hoosiers. We had a great season this year. And I primarily lead deal sourcing, underwriting, investment analysis, transactions, and all that good stuff on the acquisition side. And on the asset management side, I help oversee ongoing asset performance and execution of our business plan across the portfolio.
Good. And I mentioned, so we're 10 West Real Estate Group. We are a vertically integrated real estate investment company. So what does that mean, vertically integrated, right? So we put together real estate investments, but we have all the experience in-house. We have property management in-house. We're an Illinois licensed brokerage. We do asset management. We do all of our construction, all of our renovations, we do in-house. Okay, so we're a complete shop that runs the investment from beginning to end. All right, we're gonna jump in. So we have an hour. We have a lot to cover. As I mentioned, don't worry, this presentation will go out to everybody afterwards. But what my job here today is, I wanted to give you a framework. I wanted to give you something that I wish I had a decade ago that says, here's how you do this. Here's how you start your real estate investment career. I don't know, where everybody in the room is in it, if you've done an investment, if you're a seasoned investor, but what we're going to try to do here is cover the basics, right? So we're going to go all the way from, how do I develop my thesis? How do I develop my strategy? How do I know who I want to be as a real estate investor? We're going to cover the journey all the way from evaluating opportunities to executing the deal, right? To creating value through operations, property management. We have a lot of our company here today, so that's good. And then we'll talk about, how do I participate? How do I get started in this journey, okay? Because there's different ways to be a real estate investor, and we're going to cover off and talk about that. I mentioned we're going to stay connected. We're going to move at a pretty quick pace. We're going to cover a lot of information. We're going to leave our contact information. Find me afterwards if you want a card, if you want to connect afterwards. Happy to go deeper on stuff. If we do this right, if our pacing is right, we'll have a little bit of time for Q&A at the end, okay? All right, so 3 things that I hope you walk away with here today, okay? I want you to walk away with a clear understanding of how real estate investing works. Why should I do it? Why is it good? How does it work? I would like to make sure that you have a practical framework, and I'm gonna, share some of my experiences along the way of how do I do this. There is a sequence, there is a framework, there are steps to it, and I want to make sure that we get through that framework here today. Also, we talked about it, helping you on your journey, what type of investor you are, how do you get started, okay? So that's our agenda, that's what we're gonna do. So let's just jump right into it. Why do we like real estate as an investment? Just really quickly, how many people have done a deal? How many people have done outside of your personal residence? We got 1. You want to come up on stage and help out? Yeah, 2. Okay, very good. So we have a handful. So most people are kind of early in their career, beginners in their career. One of the things that we have a pro tip here. One of the things I want to tell people before we even go into it, when you invest in real estate as an investment, you are buying an income stream. It is income driven, and you're buying that. That is very different than the emotional decision you make when you're buying your house or your summer home, or you want to be close to your friends. This is analytical, this is data driven, and you're buying an income stream. So how does that happen? How do we make money in real estate? Well, we make it from cash flow, right? Our residents, our tenants, they pay rent. That's the cash flow that we get coming in. And that's really nice passive income. We'll talk about that later. If we do this correctly, if we lay out the right framework, your property will appreciate over time. So you're going to get the appreciated value in your property. Loan pay down. One of the things we're going to cover here is that you don't have to have all your cash to buy your investment. You can borrow from the bank, right? You can get leverage on it. And guess who's paying down that leverage? Your residents are paying rent and you're using that to pay back the bank, okay? Very unique to real estate. One big reason why we like it. Nick's going to cover off on this, but there's really great tax strategies with real estate that you don't find in other investments, okay? If you buy stocks and bonds, there's different things with real estate that you can do, and Nick's going to cover on that. Now, the other reason why we like real estate is you have some influence over the value, okay? So compared to other investments, right, if you buy Alphabet or Amazon stock or something, you don't really have a lot of influence over the value of that. Now, my wife likes to buy a lot of Amazon, so maybe those boxes showing up at our door, maybe we can increase the stock price by all the stuff that shows up. But what's unique about real estate is you can control the income growth, right? Income growth is what increases the real estate values, and we have influence over that. If you're a good operator and you can reduce expenses, you can increase net income, okay? So you do have some control over that investment.
And another thing that's great about real estate is it's somewhat resistant to inflation and also less subject to market cycles. So as Jim mentioned, because real estate is valued based on the income that it generates, in practice, as rents and income from a property increase, they tend to increase alongside inflation. So they're less subject to market cycles because it's a physical, tangible income producing asset. And because it's physical, it's much less likely to substantially swing in value in the same way a stock might. It's very hard for real estate to lose its intrinsic value and go to nothing. And then on the other hand, we have estate and tax advantages, which he lightly touched on. First and foremost, we're not tax attorneys, we're not advisors. So if you're interested in going deeper on this, we recommend you consult a professional. But ultimately, there are a variety of different ways that you can defer your taxes on both income, capital gains, and as it transitions on to the next generation. And that's why we believe that real estate is by far and away the best way to build generational wealth, create a legacy, and pass that on and preserve it.
People always ask me, Jim, you started in tech, you were a home builder. Why real estate? Why did you get into real estate? So I'll give you some practical, at least from my opinion. I love the passive income that it creates, and I love the generational wealth that it creates. Everybody in this room, I'm sure, works really hard at your job. You work very hard. But like most jobs, if you don't go to work or if you cease working, you stop getting income. Real estate is unique in the sense that when you're sleeping, when you're on vacation, when you're spending time with your family, people are still paying rent and you're still earning passive income, okay? I'm a father of 5, and I think about all the time. When I was building houses, I only made money when I was building houses. I wanted for myself and for my family a way to passively make income, and then for my 5 children, leave a legacy, right? So all the investments that we've made will grow in value over time. And someday when we're not here, there's really creative tax strategies to move that on to the next generation. All right, so this is the journey. This is the backbone of what we're going to talk about today. I don't want this to be scary, but we try to put this in 8 logical steps. And I get the question is, how long does this take? Okay, if I'm just starting today, how long does it take? So we've got rough time estimates. Okay, one of the things I will tell you is these steps I believe should be sequential. You should do this in sequence. That's the way we're going to present it today. But they do overlap. And as you become a more seasoned real estate investor, you will shorten the timelines on this. So we're going to go all the way from building your thesis to closing on your property and operating your property. All right, defining your investment strategy. Like everything in life, you wouldn't set off to do something if you didn't have a strategy. If you didn't have a thesis, I hope you wouldn't, at least, okay? And so real estate investing is no different. So there's a couple steps that we're going to talk about. And the first one is, who do you want to be as a real estate investor? So if you've chosen real estate, there's different asset classes in real estate, okay? We have multifamily, apartments. That's what we do at 10 West Real Estate Group. We're apartment investors. Which you could be an office investor. You could be an industrial investor. You could do retail. There's a ton of specialty. There's hospitality, self-storage sites. There's student housing. There's a bunch of different things. But as you know, and as I asked the room, as you're early in your career, you want to be focused and you want to be disciplined, okay? So step 1, decide which one of these you're going to focus on.
And then once you've chosen your strategy, the next thing you're going to have to do is define your risk return profile and the actual strategy and approach that you're going to take. And there are 4 sort of industry standard buckets that these strategies typically fall into, and each of them come with their own sort of predefined risk return trade-offs. The first being core. So core assets are very predictable income, high quality assets. Think brand new construction, Class A properties in a great market. Lower risk, but also with that comes lower return. After that, we've got Core Plus. These are also stabilized assets, but maybe there's a little bit more room to create some value through operational upside. But again, these are pretty stable assets, pretty good assets. So low to moderate risk and low to moderate upside. Then you've got value add. This is where we play. So value add is where you have some real opportunity to create value, whether it's through optimizing operations or forcing appreciation through renovations. These are underperforming properties that you're going to come in and create some real value. Now, this is a little bit risky because it's going to require some additional capital beyond just the purchase price of the property, typically, if you're going to do renovations. And it's also heavily dependent on your ability to execute that business plan and go in and actually do that work. So, higher risk, but also higher potential for returns. And then opportunistic is a step beyond that. It's a little bit more of a heavy lift than value add. This is ground up development or extremely heavy repositioning. So this is the highest risk because it really depends on your execution, but it also comes with the greatest potential returns.
So this is where you set your thesis, okay? I want to be an apartment investor, and I'm going to focus on core assets. I want low risk, I'm willing to accept low returns. Or maybe you're on the other end of the spectrum. You say, look, I'm willing to accept a lot of risk, but in return for that risk, I want high returns. And this is where you select your strategy. We're going to talk about this later because the number one question, I guess, how do I know if it's a good deal? You know if it's a good deal if it aligns with this strategy here, okay? So it is very defined, it is very disciplined. You pick who you want to be, and then when you analyze deals, you match it back to your thesis. And we'll tie that back in later. Okay, next, market selection. Why does this matter? So you probably have heard location, location, location relative to real estate. And I personally, as an investor, think that location is the single biggest driver of value. Okay, now it has to tie back to your thesis because if you're looking to be an industrial, you have a certain location you're looking for versus apartments, right? We have a certain thing. But location, in my opinion, is the number one driver of rent growth. It's the number one driver of occupancy. And it's going to be the thing that protects you in a down market, okay? So what do we look at? When we select markets, what are the demand fundamentals that we look at? We look at population density and growth, okay? We look at employment base and household income. We look at school districts and quality of life in the market. And lastly, and this is something that hits home here in Chicago, we want to know supply versus demand, okay? So if you read the news here in Chicago, we are very supply constraints. Okay, we don't build enough. There's the whole reason why we don't do that, but we don't build enough, which creates demand for housing, which creates higher rents. Okay, so these are the things that you want to look at. Now, you also, and this is something that increasingly over the last couple of years, you have to look at operational and regulatory concerns. Okay, what do I mean by that? So when we're looking at a market, we look to see what the local tenant landlord laws are, okay? So as I introduce my thesis to you, I play out in the Chicago suburbs. I don't play in city proper, and there's a reason for that. There's some governmental things that go on here in the city that I don't want to participate in. Rent control, right? We talked a lot about rent growth. Rent growth drives value. Rent growth is your passive income. You don't want to end up in a market that's rent control. If your business plan is to drive rents up, and then the municipality that you're in tells you, no, you can't, you have to pay attention to that. There's other things that go on. There's other policies, two that come to mind, or one that comes to mind on the northwest side of Chicago and on the southwest side of Chicago in certain wards. They have implemented a regulation where it's first right of refusal to your tenants if you want to sell your building. So imagine you have a business plan, you want to sell your property, and you have to go ask your tenants if it's okay and if they want to buy it first, okay? Wild, but it happens, and you have to pay attention because that can sink or swim a deal, those types of things. All right, so I covered this a little bit, but I want to share our investment thesis and our strategy at 10 West Real Estate Group just to put this in practice for you. So as an asset class, we focus on multifamily. That's where I believe the most demand is, okay? So we developed this thesis well before COVID when we got into real estate investing, and then COVID hit, right? And your home became more important than everything. Offices faltered, industrial faltered, retail was hit. I always believe personally, my thesis as an investor, I think that apartments are always gonna have the strongest demand. Our risk profile is value add, okay? So and that's who we are. We're leveraging our construction background, our operations background. We know that we have the ability to add value, to do our own renovations, to tighten up operations. And for that, we're looking for higher returns. Our market focus, so I think we may have coined this term urban, suburban, submarkets of Chicago. What do I mean when I say urban, suburban, submarkets of Chicago? I mean the LaGranges, I mean the Napervilles, Downer Grove, Lombard. Help me out, where else are we? But these, why do we focus on that? So our market thesis, these are the markets that we know have strong population density. These are the areas that people want to live. They have high household income, okay? And these are all the things that Nick and his team research when we're looking at it. We have good employment base. We have highly rated schools in those markets. And by the way, depending on your thesis, mine is apartments. Apartments have families. School districts, really important. But if you're an industrial investor, maybe not, okay? So this is where I say it has to tie back to your thesis. Limited housing supply, I covered that. And then the last two, we really like a high quality of life, walkable downtown areas, right? Downtown Naperville, bars, restaurants, and a metro stop, right? These are the things that people want to live around. These are the characteristics that we believe from our thesis support high occupancy, sustainable rent growth, and will protect us in a down market, okay? But these are very personal to the strategy and the thesis that you select and you want to do as an investor. Okay, next up, you gotta build a team. So I sit here before you talking, and I have a lot of team members here tonight, okay? And real estate investing is a team sport. I will tell you firsthand, you want to have knowledge of everything, but you need to have a good team in place. Why does that matter? Speed of execution, right? If you find a deal but you don't have a lawyer or you don't have the right team members, you want to make sure you have the right team members in place. Risk management. If you've got smart people on your team, they're going to help you head off, things that might danger the investment down the road. And this really is just a good team, higher probability of long-term outcomes. So what do you look for? Nick is going to go through and talk a little bit about how to build your team, but what do you look for in a team member? There are certain characteristics across this that you look for. Experience in your target market and your asset type. So I just told you I look for apartments in the suburbs of Chicago. I don't need a broker that is industrial in St. Louis, okay? That's not helpful, so you want to make sure that you select your team that aligns with your thesis and your strategy. I also said that I'm a value add, right? I look for value add properties and I look for things that have a higher return. So it also doesn't do me much good if someone brings me a new construction building and it just doesn't fit my thesis, okay? Responsive, accountable, that goes without saying. You want to make sure you have people on your team that answer your questions and are there working for you. And the last one, make sure that you don't have make sure people challenge your assumptions and just don't say yes, okay? Very important. You want to have people, I have people here in the room that challenge my assumptions every day, which is good. You naturally in your journey to invest, you will want to do your first deal. Or maybe you've been looking for a deal for a long time, and then all of a sudden you start getting emotional. Maybe, possibly I found this deal. Well, you want to have someone who's going to tell you no, that doesn't work. Typically, right, a good person on the team is your lender. You go to your lender, you say, I'd like to put debt on this property. Here's my business plan. Here's what I want to do. And then they underwrite and go, that doesn't work, okay? So you want people who tell you that. It's better to hear no up front than a failed investment down the road. Nick's gonna fill in the blanks here about who should be on your team.
So now that we've covered why the team is so important and what to look for in the team members, who are we actually bringing on to this team? First of all, you've got your brokers. These are going to be your primary source of deal flow, especially when you're first starting out, and they'll always still be around. Second up, lenders. He lightly touched on them. Every time you go to acquire a property, you're going to need capital. One of your biggest sources of capital is typically your debt. So you want a lender who's going to be able to get you good terms. Next, you're going to need an attorney. There's a lot of different risks and contracts and things that happen in the real estate space. You're going to want an attorney who's got you covered there. Up next, and arguably the most important person on your team, is your property manager. And this is one of the biggest decisions that you're going to have to make as
property managers. We have a whole slide dedicated to you guys.
So this is one of the biggest decisions that you're going to have to make as you're building your team, is who's going to be your property manager. And the reason that they're so important is because they are responsible for overseeing all of the day-to-day operations of the property, maintenance, collecting rents, all of that good stuff. And there's two kind of paths you can go down here. You can either choose to manage it yourself, or you can outsource to a third-party manager. As Jim mentioned, we're a vertically integrated company. We have in-house property management, so we can be a fiduciary back to our own investment. Up next is an insurance advisor. Insurance, outside of property taxes, is probably one of your biggest line items on your property's P&L. So you want to make sure that you have a good advisor who can get you a good rate and good coverage. And then beyond that, you're going to need an accountant, tax advisor. We mentioned that there's a lot of tax benefits to real estate. You want someone who knows you well, knows your specific situation, and can help you take the full advantage of all of those benefits. And then there's going to be a handful of other different people that you'll need along the way: inspectors, contractors, vendors, as you begin to operate the deal. But the ones that we outlined here are the core people that are going to be the most important and you will have with you long term.
Good. So get your team together. Good people. All right. Now you got your team together. You have your thesis. You have your strategy. You're pointed in the right direction. Now it's really, where do I find a deal? Okay. In the life cycle of real estate investing, this is probably the longest and probably the most frustrating. In today's economic market, with interest rates not where they used to be 5 years ago, it has been challenging to find deals. Okay. Deals are difficult. That is one of the most difficult things that we deal with. But it will tell you this: stay focused on deals, stay disciplined on deals. When a market is bad, when deal flow is low, you start to come off your thesis, you start to come off your strategy. All of a sudden you go, well, what about the suburbs of St. Louis? Or what about all these things that maybe I don't know, maybe I haven't spent time on? Stay focused. This isn't to say that you can't, when you become seasoned, expand the goalpost a little bit. But if you're early in your career, stay disciplined, stay focused. And that is also going to bring the right deals your way. So there's really two ways to do this. And if you're early, even throughout your investment journey, brokers and on-market deals, that's how I started my career, right, are going to help you. So you want to start to form, Nick talked about this with your team, you want a lot of brokers, not just one, you want a lot of them that operate in your area. They're going to be your primary source of deals early, okay? They're also, if you're new to analyzing deals, they're going to help you a little bit, okay? They're going to put together a pro forma, they're going to put together an offering memorandum. Those things are going to have loosely put together financials. Now, caveat, you still have to do your research. Don't trust anything that anybody gives you, okay? We look at it and we say, thank you for the help, but we do our own underwriting, okay? So, pro tip right there. You want to stay in constant contact with these people. And again, focus on the brokers that are most active in your market and align with your thesis. Now, having said that, those on-market opportunities are going to be the most highly competitive because they're on market and everybody's looking at it. Especially today, I see a deal go on the market. It's like piranhas, coming out for the deal. So it's very competitive. So what Nick's going to talk about and what he has built over the last couple of years, and what one of our great advantages is at 10 West Real Estate Group, is our proprietary deal sourcing off market.
Yeah, so taking it away from Jim, broker and on-market deals will always be there, but off-market and proprietary sourcing, going direct to the owners, has been a huge focus of ours. And the way that started out for us is taking Salesforce CRM and looking at all of our core geographies. So across DuPage County, suburban Cook, parts of Lake, parts of Kane, we have identified every single property and gotten it into our database. Once you've identified the property, we hand curate and figure out who every single owner is of each property and what their contact information is. And from that moment forward, we are in constant, persistent contact via a variety of communication channels, whether it's making 100 plus phone calls a week, weekly emails, monthly postcards. Some of you here may have received them before, maybe that's why you're here. But it's all about persistence, and these relationships are built over weeks, months, sometimes even years before a deal may come to fruition. But if you can get one done off market, it's great.
As we still use brokers, we still look at on-market deals, but in a competitive environment, you have to compete, okay? And that's why we built this database, and we're going direct to owners, and we're trying to get first in line for these deals, okay? So, let's say you found a deal, or you found some deal flow, okay? So you got your team together, you got your strategy, and all of a sudden deals are coming, brokers are bringing deals to you. You have to be able now to analyze the deal, okay? What we talk about with the term, has everyone heard underwriting? Underwriting a deal, okay. So we could teach a whole class on underwriting. Nick and his crew underwrite 10 deals a week. He's really proficient at this, but I just want to give a quick underview. Underwriting, okay, is the disciplined decision-making process, okay? This is where you're going to look at, what is that property worth today? What could it be worth in the future if I execute my business plan? Okay, this is where you're going to justify the risk and reward. Okay, you're going to analyze the deal and go, does this line up with my thesis? All right, underwriting is not emotional. Okay, it's discipline, it's fact based, it has no room for emotion. Okay, you picked your thesis, you picked your strategy, now you get a deal, you crunch the numbers, and honestly, it works or it doesn't. Okay, so how do we think about underwriting? Factual, disciplined, right? Designed to identify risk, right? And it evaluates again at the end of your underwriting process. Really, the question you're trying to answer is, does this align with my investment thesis?
So now that we've covered what it is and how we think about it, here are some key principles that you should always follow so you don't get yourself into a bad deal. So first of all, be realistic and conservative with every assumption. Your assumptions should reflect what is likely to happen, not what is possible. You want to be conservative here. Second, never manipulate inputs to make a deal work. There's a million different levers you can pull when you're underwriting a deal, but you want to let the deal speak for itself. If it looks good, let it say that itself. Don't start pulling levers to make it look better than it is. Next, base decisions on verifiable income, not optimism. This one is super important. Sometimes you might feel like you want to plug in a number because it feels right. We advise you to never rely on intuition. Always have some sort of fact, piece of data, industry standard that you can point to and back up that number for that assumption. Otherwise, it's not grounded in anything. Lastly, if you're going to be wrong on the conservative side. It's always better to underproject and over-deliver. So let yourself be surprised in a positive way and be comfortable in a downside scenario.
Good. So just to loosely cover the underwriting process, we have a massive 12-tab spreadsheet that we bring everything into and crunch numbers. It's something that we've curated and developed over time. But I tried to really distill this down to 5 steps, and everyone's going to have their own model, their own process, but it does follow these 5 steps. You're going to analyze current performance. How do you do that? So how do I know what a property is worth today? Well, you're going to ask for either from the broker or from the seller, give you a current rent roll. That rent roll is going to tell you the income side of it, okay? It's going to tell you, what are you currently charging? What is a tenant paying? And do I have any vacancy in the property? You're going to ask for a trailing 12 financial statement. So I'm looking at Katie, who does finance, a trailing 12. A trailing 12 financial statement is really going to give you 12 months, the previous 12 months of how did that property operate. Now, you're going to hope that they kept good books and everything is accurate, and you're going to see 12 months of income, and you're going to see 12 months of expense. Those are really the inputs and that we can sit down and go, okay, what does it look like today? Now, the next step is, what does it look like when we take it over, right? You're going to build what's called a pro forma, which is your future looking assessment. So you're starting with your current performance, and then you go, okay, so where can we move rents? Do we think that we can raise rents? Do we think we're better operators at 10 West Real Estate Group and that we can run it more efficiently and therefore reduce expense? Okay, so you're looking for different ways. Maybe there's improvements, maybe there's renovations or things that can happen, okay? Every assumption though, and Nick talked about this, has to be rooted in fact. So if you said, if Nick comes to me and he goes, I think we can move rents from 1,500 to 2,000, I go, tell me why. And it better not be your opinion and your intuition. And Nick is very good at this. I'm not saying he does this. He will come to me with a market analysis in the area, similar properties. What does it look like when they're renovated? What are they currently getting for rent, right? We've built this suite of tools so that we have confidence. Yeah, we definitely think we can take it to 2,000. Why? Because it's probably already been done. We just need to execute it. So everything has to be defensible. All right. Now, when you do this, you do have to model your returns over a whole period. Okay, it's something we haven't talked about, but when you're underwriting, it isn't just open-ended. You go, I'm going to buy it today. I'm going to hold it for 5 years. I'm going to hold it for 10 years. Okay, and you have to hit those metrics over a defined hold period. Now, I mentioned that we're value add operators, right? So we're going to look at a property and go, sometimes we get some pretty beat up properties and I go, great. It scares a lot of people. I go, this is great. I am looking for ways that I can do unit renovations, common area renovations, exterior renovations, all that stuff that a tired property might not be able to command a lot of rent. But if I go in and do it, now I can raise rents. I'm also looking at it and saying, what can I do with operations? Maybe it's heavy on payroll. Maybe it's heavy on something. We've got a state-of-the-art team. We've got the best team in the world, right? How can we bring those expenses down? So that step 3 is where you're looking for those opportunities. Step 4, you better write those into your model. Okay, so if I go, hey, I got a 12 unit apartment building, I'm gonna renovate all 12 units and get $2,000 a month. It's gonna take time and it's gonna cost you money to do that. And you need to make sure that you build that into your financial model. Okay, so it can cost $25,000, $30,000, $35,000 to renovate a unit. So if you don't have that in your model, it's gonna blow up really fast. So make sure you have that. So that's step 4. Make sure that you underwrite the time and the money into your model. Okay, now you have this thing, and step 5 is validate it. Does it align with my strategy? I've done my work, I've underwritten it, everything is defensible, I believe in the numbers. Does this line up with who I am as an investor? Does this work as a urban suburban apartment building, and does it align with value add metrics? Okay, that's what we're looking for, and that's the last and final step of your underwriting. Next question should be, well, what metrics do you look at? How do I know? What am I looking at? Now, if anyone's interested, I have a book that defines 55 real estate metrics and gives you calculations and why they're important, and I've read it several times. What we try to do here, I was going to put you through that. What we do here is what are some of the core ones, and this isn't all of them, but what are some of the core ones you should look at when you're underwriting a deal? Okay, you want to look at price per door, right? So if you're buying a 12-unit building, what does that purchase price look like per door? And that's a directional metric, right? You can look at other buildings and go, well, this 12 units sold for that, this 12 unit, right? It's a directional metric. We mentioned that real estate is all about the income that it produces. Now I'm going to put a little spin on it. It's actually about the net income, the net operating income. What is net operating income? That is your income minus your expenses, and this is what's left over. This is what's left over to pay your debt service. This is what's left over to put money in your pocket, okay? So it's not just about the income, it's about the net operating income, and we pay close attention to it. The next two are kind of related. I'm gonna kind of gloss over. Cap rates are important, right? There's sort of a ratio between your net operating income and your purchase price, or your stabilized net operating income and your total cost, right? So the unlevered yield on cost is a really interesting one, because it says, okay, if I renovate all 12 and I had to put $300,000 in it and I was able to raise rents, what does my yield look like after rents are stabilized and up and I've accounted for all that, right? So this is the one that says at the end of my business plan, what does it look like? On the right side, probably some stuff you're very familiar with, things you've heard before, cash on cash return, right? Your annual cash against your equity invested. IRR, right? Does anyone know what IRR is? Okay, IRR is really, what you need to know about it is it's time-based calculation, and it's gonna help me understand how fast I'm getting my money back, right? So that hold period that we talked about, right? You're measuring IRR, right? So if I wanna make X dollars, I need to make it over 5 years, not 500 years, right? So it's gonna tell you how fast you're making your money back. I personally, one of the things I look at the most is a multiple on invested capital, okay? So at the end of your defined hold period, say it's 5 years, how much money did I actually make on my investment? And this is a very basic calculation that says for every dollar I put into it, how many dollars did I get back? So if I put $1 into it, and in 5 years I have $2 to show for it, my multiple is 2, right? So I doubled my money, or tripled my money if I have $3, okay? This is one that we look at. I like that a lot. Nick is gonna talk about leverage, how much you put on there, why we focus on there. Leverage is great, but you got to be careful with it. You don't want to over lever a property. And that debt service coverage ratio is sort of how comfortably I can pay back my debt service. Okay, so you've underwritten your deal. I don't want anyone falling asleep, but these are the things that you look at. These are the metrics that you look at. Okay, now you say, is it a good deal? Well, let's go back to our thesis. Okay, so Nick talked about this earlier. Right? There's different levels of risk. And for the different levels of risk, you're expecting a certain return, right? So if I'm a core investor, right, this is the lowest risk, and these are going to be the lowest numbers. And again, these numbers are general guidelines. Everybody's different, everybody's unique. This would be what I would be looking at in these categories, okay? Now, as your level of risk goes up, and I mentioned we're value add investors, right? So that's on the riskier side, right, of the investment spectrum. I'm going to want higher IRR. I'm going to want a better cash on cash return. I'm going to want a higher multiple, right? And so those are the things that we look at. So when people go to me, hey, how do I know if I have a good deal? It's right here, okay? So it's your underwriting, it's the metrics that you get, you bump it up against your thesis, and if it works, it works. Okay, so it's very mathematical, it's very data driven, and you got to try to keep some emotion out of it. Okay, right? We all get emotional about stuff, but if you want to be a good real estate investor, it's all about the numbers.
So now you have the deal, you've underwritten it. How do we actually take it from that underwriting stage to getting the deal under contract? First, you've got your underwriting, you're going to look at your numbers and you're going to stress test them, make sure that you're comfortable with the downside scenario. And from there, you're going to come up with 3 numbers. First, you're going to define what price do you like the deal at and where do you want to make an offer. Next, where will I stretch to? And lastly, at what price will I walk away? What is my ceiling? This is going to be really important as you go into the negotiation stage because you don't want to pay more than you're comfortable with. So once you've figured out that number that you want to make an offer at, you're going to put together what's called an LOI or a letter of intent. This is your handshake agreement. It's not binding, but it's where you're going to outline the basic terms under which you want to acquire the property. So things like purchase price, number of days you want to do diligence, basic terms like that. And then rarely does your LOI get accepted on the first pass. So typically you're going to make an offer. There's going to be a stage of negotiations. You're going to go back and forth, maybe on price, maybe on terms. But ultimately, you hopefully come to an agreement, at which point you're going to bring in your team member, the attorney, and they're going to help you draft a purchase sale agreement. And that's going to be very robust, outline all the terms, protect you from any risks, and then that'll get executed and your deal will now be under contract.
One of the most important things, some people live to negotiate, right? We all know that person that loves to negotiate, and some people fear and loathe it, okay? One of the things that Nick talked about here that makes that easier, depending on where you are on that spectrum, is know your target price, know your stretch price, and know the price that you're gonna walk away, okay? If you set that in your mind before that LOI goes out, now it doesn't seem as hostile, right? You go in there, you make your offer, you go back and forth, okay, now they're at my stretch price, I could do it, it still works. Okay, now they're asking for more, I walk away, okay? And you gotta be firm and disciplined, words you're gonna hear me say throughout this. But if you do that, it really takes this thing out of this step. Okay, Nick submitted an LOI, they negotiated it, we have an accepted offer, okay? We have a handshake, now the attorneys are gonna go, they're gonna work on a contract. As part of the contract, we're going to define our due diligence terms. Okay? I cannot stress how important this is. Everything up to this point, you did your best to validate stuff, but it was hypothetical. You were given information from a broker, from a seller. You did your best. You researched. You did everything you could. But now, in due diligence, this is your chance to actually validate your business plan. Okay? And there's really 4 steps that I look at when I look at this. The first one is financial due diligence. You gave me a rent roll. You told me you make this much money. This is your opportunity to go give me all the leases. I want to see all the executed, signed leases. I'm going to look at them and I'm going to compare them to what I said. Hey, unit 1 is paying $1,200. Okay, the lease says $1,200, right? And you're going to do that for every single lease and you're going to validate that income. This is the first time that you actually have the opportunity to say, look, you said expenses were this. Your trailing 12 financial said expenses were this. Show me the tax bill. Show me the electric bill. Show me the gas bill. Show me the water and sewer bill. I'd like to see your insurance, a copy of your insurance. Like, this is where you get to validate those assumptions. I told you I'd pepper this with real world experience. I bought a 24 unit building. It was 2 side-by-side 12 unit buildings. I was given everything by the broker. We underwrote it. We followed our process. We submitted an offer. In due diligence, I found out they only gave me expenses for one 12 unit building and not the other. Okay? Huge, right? That means the expense is now doubled, actually, right? And so in that situation, we were able to renegotiate. But if you don't catch that, and if you're not diligent, it's over. That deal is upside down, okay? So that is why you do it, and that's where you find it. Physical due diligence, okay? Maybe you're buying a 12-unit building. You toured the property. You got in 2 units. You got to see the storage lockers. You got to see whatever you could. Now, you're making your offer based on that. Okay, this is your chance. Now you go back and say, I'm going to turn it over. Okay, and talk about building your team. This is probably where you're bringing in a professional inspector. Okay, maybe you know a roofer. Maybe you have an HVAC guy that you can bring with you. Do we know any HVAC guys over there? Yeah. All right, so you bring them with you and you go, now I want to get up on the roof. Now I want to see the mechanicals. Now I want to see all the stuff I didn't see, okay, when I made my offer. This is important. You get up on that roof. You did not budget $40,000 to replace the roof. And your roofer goes up there and goes, it's a tear-off, $40,000, $50,000, okay? That's why you do this. That's why this is important. Now, you try to see as much of the property as you can before you make the offer, but this is where the rubber meets the road. Operational due diligence, right? You're looking at the way they run the property. Tell me how it staffs. Tell me how you do things. Can I find efficiencies there? Legal and compliance review. This is where another team member, this is your attorney, right? And they're very important in this stage. They are reviewing the contracts. They're reviewing the leases. They're looking at the title. They're making sure it's a clean title. They're looking at the survey to make sure that the property that you think you're buying is the property you're buying, or to make sure that you don't have an easement running right through, the middle of your property. So all of these things, this is your chance, okay? How long does it take? It depends on how big the property is and how complex the deal is. I put up there 45 to 90 days, right? Typical to do this, but it varies by deal, okay? Now, you're gonna do all this, and there's really 4 possible outcomes, right? Everything was perfect. Proceed as planned. We're going to buy the deal as we said we did. Does that happen? Rarely. Okay? Rarely does that happen. Maybe you're going to renegotiate price. So I brought up that example where I was given half the financials and I went back and I said, that doesn't work. I'm not buying the property for this because you weren't forthcoming with financials. In that situation, we were able to renegotiate price once we were given everything. I mentioned your physical inspection, right? You can request a credit or a repair. You could say, listen, I didn't know the roof was in that bad of a shape. I'm going to either have you fix it, which never really happens, or I'm going to ask for a credit to fix that roof. We'll go get 3 bids or you go get 3 bids, so it's fair. But I didn't know about that. If I'm going to buy this building, we're going to renegotiate that. Okay? And the last option, the 4th option, if everything just really falls apart, nobody wants to work with you on it, you walk away from the deal. Okay? All right. Got a couple lenders in the room here, right? I see you out there. All right, leverage is huge, and I see a couple guys in the room. Talk to them afterwards. They're going to do a much better job at explaining this than we are, but it is what's unique about real estate, and I'm just going to do this from a very high level, okay? You don't need 100% of the money. If I want to buy the $1 million building, I don't need $1 million. I need probably 30, 35%. I don't know what you guys will tell me over there, but that's unique, right? So I don't need that. I don't need $1 million to do it. I can borrow money to do it. And by the way, that debt is going to be secured against my asset. But what's really interesting about that is who pays back that money. So I borrow money from the bank. It's the rent that I bring in that pays off the debt, right? So that's what's really interesting about real estate. Why does leverage matter? Because it enhances your ability to do it, okay? If I don't have to spend $1 million on one property, I can spend a third of that. Now I can go buy 3 buildings. Or maybe I can go buy a bigger building, right? So it extends your power as an investor when you do it.
And so there are a few key considerations, both for you as the investor and also for the lenders, that you're going to want to pay attention to. The first being loan to value. So this is basically how much debt are you taking on relative to the purchase price or the property value. And the takeaway here is the higher the leverage, the riskier it is both for you and for the lenders. So you want to be very intentional about the amount of debt you're taking out. And then next up, we've got debt service coverage ratio. This is another very important one. It essentially measures your ability to comfortably cover the debt service payments. So the money that the property is spitting off, you want it to be higher than the amount that you owe on the debt. So the higher the debt service coverage ratio, the better it is. This is also going to affect what terms the lender will actually give you because they have a certain threshold they need to meet. Next up, interest rate and term. Interest rate is going to tell you how expensive is it to borrow this money. As the investor, you want to see a lower interest rate. The lower it is, the cheaper it is to borrow money, the more you can get. And your term is typically going to coincide with your hold period. We talked about your hold period, maybe it's 5, 7, 10 years, and typically your loan term is going to be the same. And then amortization and maturity along with term are also going to be typically aligned with your hold period, but amortization is going to tell you how fast am I paying down that debt. You might be able to spread those payments over 30 years, 25 years, so your current payments are not as high.
This is just a very high level. Again, you could do a whole class on why debt, why leverage. There's a bunch of other things, recourse, non-recourse, Fannie, Freddie, all these other things. I can introduce you to someone in the room. They can do a much better job at us. But from a high level, this is what you should know as a beginning investor. All right. We got our deal, right? We're going to close this deal, right? We made it through this process. We decided, hey, this is the deal we want to do. How does that work, right? So we're going to close that deal. That financing we just talked about, right? We're going to secure that financing. We're going to lock it up. We're going to make sure our debt's in place. One of the things that we haven't talked about is okay, you have to come to the table with money. How do you raise that equity? How do you raise that cash? Maybe you intend to pay for all of it yourself. Maybe you intend to raise it from investors, right? There's different ways as well that you can bring equity to the table to buy real estate.
And so once you've gotten your funding in place, whether it's debt and equity, you're going to have to complete your legal and title work. This is where your attorney is going to cross the T's, dot the I's, make sure everything looks good and is squared away there. And then while all of this is going on, you're going to want to prepare for ownership transition. So this is extremely important. You're going to want to coordinate with your property manager, whether it's going to be you or it's going to be a third party. You're going to want to coordinate with them because as soon as those keys are handed over and the ink is dry, the responsibilities of owning that property all fall onto you. So you're going to want to make sure utility bills, all that stuff is in your name and you've got your property manager ready to field any issues that might come up as you take possession of the property.
All right, so that's a great transition into property management, right? And it's scary. I've been there. I've been sitting at the table. They hand you the keys and they go, it's yours. And that next link, leaky faucet or tenant dispute or someone who doesn't want to pay rent, that is immediately and instantly yours, okay? So you have to be prepared for that. Property management, this is where value is created. This crew, this company that we have at 10 West Real Estate Group, our vertically integrated property management, that's where we make our money, right? That is the operations. That is where we execute that business plan that we talked about, okay? This is the day-to-day stuff that you need to be aware of as a property manager, whether you do it yourself or whether you're going to hire somebody. Leasing, rent growth, collecting that rent. This is a day-to-day, daily thing, okay? Maintaining the property. Does it look good from a curbside? Does a tenant have an issue? These are now all your responsibilities. Expense control and vendor management, right? So we talked about net operating income. You can't let expenses swell out of control, right? You have to figure out a way to manage that property efficiently. Bookkeeping and financials. I couldn't live without Katie over here. Super important, okay? Super important. If you want to know how your property is operating, you have to have your bookkeeping right, okay? If you want to take advantage of some of the tax strategies and things, you have to have your bookkeeping right? It's something that Katie and our company does very, very well, and we're very efficient with it, and is super, super important, okay? Awesome. Yeah, let's go. All right. The last one can't be overlooked either, and this is increasingly important, it's just, especially in the city that we're in Chicago with a lot of regulations and a lot of rules. We talk about this all the time, compliance, okay? Fair housing laws. You are now operating, okay, a property. You have to be aware of fair housing laws. If you're not, you will, the fines are crazy. So you have to make sure you're treating people fairly. There's a whole host of things that you have to do, and you have to be compliant. Your leases have to be compliant. We are now working on new leases, right? There is stuff that comes out, this year alone, there's new laws in January. There's new laws in February. We're going to introduce a new one in June. You have to make sure that your lease is compliant and up to date, okay? Otherwise, you can find yourself in trouble. All right, a little bit about our crew, our property management approach, right? Because I think this is our competitive advantage. I think this is what we do really well. If you're thinking about starting your own property, managing your own property, here's a little bit of advice and things that I've learned along the way. When I first started, it was a very antiquated space, right? It was very old school. I came from a technology background. I came from a strong operational background. I literally started to twitch when, I started out in property management. Our philosophy is this: technology first. There's a lot of technology and there's a lot of ways that you can automate stuff that people are spending a lot of time doing. It's my strength. It's my background. This is what I know. We've implemented a ton of technology, a ton of implementation. AI makes a lot of this easier of having centralized teams, right? Centralized teams and scalability. Okay, so we have 830 units, 18 properties spread out across the west suburbs, right? I'm going to give you one example of how we centralize this and why this is super important. So at one point, we're doing tours, we're doing applications, and we're screening people, and we're getting back to people, and we're doing that in 18 different locations, okay? We have now brought that in-house. We have a really good centralized team here. We have brought that in-house, so the property managers out of the property, they still show the property, they still sell those units, right? But the application goes out, it comes back in centrally, we screen it centrally, We send leases out centrally. We sign, we countersign leases. That all happens in our office in Westmont. And here's why. Because if something goes wrong, or if something's not right, or we discovered some fraud, it's not operationally efficient to go out to 18 properties and tell people how to do it differently, okay? We now have one hub. If I added 18 properties overnight, if I walked into work tomorrow and we had 36 properties, you might not like it, but we're scalable, right? We're scalable. It doesn't change. The process doesn't change. I don't have to go out to the property and say, here's how you screen a tenant. So you're going to want to use centralized operations where you can. We also use a lot of remote resources. Off the top of my head, we have people in the Philippines, Nicaragua, and Mexico, right? And so that is a way to efficiently operate as well, okay? If things don't have to happen at the property, you look for ways and efficiencies to do it, okay? Renewals happen out of Mexico, right? So, right, so process driven. For anybody in the room who works with a company, they know what I'm about to say here. Standard operating procedures. Every process in our company is documented. Everybody knows how to do it, and it's done consistently across all 18. And if we get 19 tomorrow and 20, we're going to do it the same way there. That's how you win. That's how you scale. Lastly, the people, you got to have good people and you got to train those people, right? So for anybody who knows me, I'm pretty hands-on. I meet with people weekly, multiple times a week, right? We have great people. That is what makes us survive and thrive, okay? And we're constantly training. We're constantly learning. As these guys know, I always set the bar higher every time we hit the bar, we go higher, okay? All right, so that's property management and that's the operations. Nick's going to talk about asset management.
So property management, asset management, they sound similar. The main takeaway and the way to simplify it is property management runs the building, asset management runs the investment. So what is the difference? The asset manager is monitoring the financial performance of the property, trends, seeing how that's tracking against the assumptions that you made back when you underwrote the deal before you bought it, making sure that the property manager is hitting certain KPIs that you've set and holding them accountable. Decision making, we know what the business plan is as the asset manager. Are we renovating units? Are we pushing rents? Are the renovations on schedule? Are they on budget? When are we pushing rents? How much are we pushing rents? Is it a good time to refinance? Is it a good time to sell? These are all decisions that you're making at a higher level that are beyond the day-to-day and more strategic. And risk management, there's going to be a variety of different things that come up. You want to have strategies in place to mitigate those risks. And then alignment and communication. You really want to make sure that your property management and your ownership have shared common goals and that they understand what those goals are, and there's a clear line of communication between all the teams involved in running your property, and also very clear communication on how the property is performing to your investors or stakeholders if you have them.
So it's really a handshake. Property management and asset management are the handshake, right? As Nick said, one's running the day-to-day, one's very operational. The other keeps the eyes on the prize. Okay, this is where you're looking at the financials. You're making sure that you're executing your business plan and it's working, okay? Both of them very important. All right, so we're kind of getting to the end here and you're probably saying, how do I do this? How can I participate? You know, maybe you started, maybe you haven't. There's two really distinct approaches to this, and there's no single right way, right? This boils down to who you are, how much time you want to put into it. But there's two different ways to participate and become a real estate investor. Okay, there's active, which means you're going to go out and you're going to do all the steps that we talked about, and you're going to do those yourself. Okay, so you're going to directly own the property. You're going to do everything that we talked about here. And then there's passive. Okay, so what does passive mean? Passive means you're going to find somebody who's already doing it, who's looking to bring investors into the deal passively. Okay, so this means you're going to find a general partner, we call it a sponsor, there's different terms for it, someone who is structuring a real estate deal, right, and looking to bring in, I mentioned there's different ways to bring equity to the table, someone who's looking to raise outside capital and bring that to the table, and that's passive investing, okay? So active is all you, passive, you're piggybacking on a good operator, okay? What does it mean? I try to do a little sort of side-by-side comparison so that I can set the table so that you guys can figure out who you are and how you fit into this. What does it mean from a time commitment? Well, I think you can guess on the active side from everything we talked about today, it's pretty intense. If you're going to go out and do all these steps and run the day-to-day, you have to be able to dedicate a lot of time to it. Now, on the flip side, if you're a passive investor, there's little to no involvement. You have no day-to-day involvement, okay? You have chosen a sponsor that you trust, has a good track record, Obviously you have to do your research on that and make sure that you have a good deal sponsor. You give your investment to them, they're going to run the day to day. Okay. Control and decision making, right? Are you a control freak, or where do you sit on this? Well, with active investing, you got to make every decision, right? That toilet's clogged, how do I handle it? This person didn't collect rent, do I evict them? You're making every decision. Is it time to refinance? Is it time to sell? You're making every decision on that side of it. Again, on the passive side, you're trusting somebody to make those decisions. You're trusting that they have a thesis that you believe in, a good track record, and they're going to make those right decisions. So very little responsibility from the control side. Responsibility and liability, again, this is a huge topic, and I'm gonna try to focus in on your investment. So when you're an active investor, you're responsible for everything. Okay, if I went out and bought a $3 million building and I got $2 million worth of debt, I'm responsible for all that. I'm responsible for that building. I'm responsible for making that debt service, and I'm responsible for what happens if I don't make that debt service, okay? On the flip side, if I'm a passive investor and I've chosen a sponsor to run it, I am only liable to my investment, okay? So if I gave that deal sponsor, put it together and say, here you go, here's $100,000. This is my investment. I want to partake in your investment. Your liability is limited to that $100,000 that you put in there. Now you could lose it, right? So that is a likely, not likely. That is something that could happen, but it's unlikely in real estate. But you're limited to your investment. Capital requirement and access, similar topic. If I want to go buy that $3 million building, I've got to go get $2 million in debt. I've got to put $1 million down, right? So I have to have $1 million to participate. Whereas your capital requirement on a passive side is really set by the person putting the investment together. The general partner, the syndicator, the sponsor, there's a lot of terms for it. They're going to put out a deal package, and they're going to say, hey, you could participate in this 300 unit building, and we're only asking investors for $50,000, right? So it's a nice way to get started with a smaller amount of money and be, frankly, in a more diversified, bigger investment. Skill and experience. I hope if you learned nothing from this presentation that it takes a lot, right? You have to have a lot. You have to be, and anybody in this room could do it. It just takes time. But if you're going to do it, if you're going to spend the money, if you're going to be an active investor, you have to learn all this stuff, and it's going to take a lot of time. Now, on the passive side of it, it's easy for me to say you don't have to, but you still should. You still should know. You still should research your sponsor. You still should understand all of this. But at the end of the day, you're looking at the skill set of your investor, sponsor, general partner. Okay, so hopefully you kind of understand the two paths to invest, right? What it means to be active, what it means to be passive. And again, there's no right way. It's really who you are and what path you want to go down. All right, we made it to the end. All right, so we have a Q&A, but I'm going to leave this up here if anybody wants our contact information. If anybody wants to continue the conversation, go deeper on anything, get a copy of this presentation. I'll leave this information up here. But I think we did it. We did it at a good pace, so we have time for questions. So let's see if you can stump us with some questions. All right, we got one over here.
So you mentioned the deal package, and
Yeah.
so if you're new to wanting to go into more of the passive, how do you understand if the deal package is a good one if you've never done that?
Yeah, it's a great question, right? And so it's a lot of research and looking at the sponsor, the person putting the deal together. First and foremost, there's a couple things I think of. They're gonna say, hey, this is a deal package for this deal. Now, this is why you should know how to underwrite deals. You should look at the metrics. You should say, does this deal feel right? Does this have the right risk profile? Does this investor have a good track record? Can you show me other deals that you did? What are the return metrics? What does it look like? There's a couple other smaller things that I think are tip-offs as to whether I do a ton of active investing, and I also do passive investing. I'm also passive in deals. I take a look and say, you want to make sure, okay, so this person's raising money, but do you have skin in the game? Do you have money invested in? It is a absolute tell if that person is raising all the equity required for the deal. So if I'm going to go out, I'll use the $3 million deal. We're going to put $2 million worth of debt. We need $1 million, and I'm raising $1 million from investors. I probably wouldn't touch the deal because you have to have skin in the game. There's no risk for that person, right? That person could raise all the money from investors, go to the back of the room and get a non-recourse loan, and all of a sudden, if that deal fails, they didn't put the money in, and the bank has no recourse on the loan, right? So those are some of the things, and there's a whole host of other things that you look at, but those are some of the real sort of early tests that I put something through to make sure it's something I want to do.
And you have that all on your website too, because you know how to do these.
Absolutely. And if someone's interested in passively investing at 10 West Real Estate Group, it is something we do. We do put real estate investments together. We do invite investors to the deal. If it's something that you want to talk about more, definitely reach out to me. I'd love to hear about your investment goals, what you want to do, if there's something that we're involved in that maybe aligns with what you want to do. Good questions. Who else? Anybody else? Go ahead. You can be it. No? We got one over here.
So it goes on to after you bought it, the big question, especially Illinois, move-in fee or deposit?
Great question. So just to recite the question. So you bought the deal, you're setting up operations. What do you want to do for new tenants that move in? Do you charge a security deposit or do you charge a move-in fee? And there's rules and laws around both, and that's specific to the municipality that you're in. So the first answer to that question is understand that, okay? What are the laws around security deposits? What are the laws around move-in fees? And am I willing and operationally competent to do that? Security deposits in Chicago, in Cook County, are very difficult, okay? They're very difficult. There's a lot of laws around it. If you're not prompt, there's laws on how you can take money out of security deposits, how fast you have to return it. And by the way, if you don't hit those, it's going to cost you a lot of money, okay? So my answer to that question is move-in fees. I like move-in fees. I think at the end of the day, so if someone's moving into a $1,500 apartment, you could charge them a $1,500 refundable security deposit, or what we do is a $500 move-in fee, okay? Why do you hold a security deposit? You hold a move-in fee and a security deposit are collateral against any damage that happens to your unit. What we have experienced over time is that the $1,500 is clearly greater than the $500, but it's so hard to take that money. It's so hard to hit that security deposit. It's a very gray area, whether it's wear and tear or it's damage. I hung a TV and I have a hole in the wall. Is that wear and tear or is that damage? How big is the hole, right? Like these are the things. And by the way, there's opportunistic lawyers. I hope there's no lawyers in the room, no offense. There's opportunistic lawyers that are looking to capitalize on that. So it has become harder for us to do that. We look at it and we say, hey, it's a $500 move-in fee. There's laws around that. You have to explain what that is. You have to detail that in the lease, and you have to give them a receipt for their move-in fee. But I would rather take the money up front. And listen, if they do more than $500 worth of damage, it's tough, but you've now collected $500 non-refundable. Most people are respectful. I think you're going to come out on the good end of that with move-in fees. But it's a good question.
Good answer.
Thank you. Thank you. What else? Anybody else? Got one in the front here.
With the passive income deals, the packages you were talking about, like from an investor standpoint, say you have $100,000 that you want to invest, and you're looking at one of your portfolios. Is it 5-year plan, a 10-year plan? Are you selling that building at the end of it? Are we getting monthly paybacks, quarterly? Like, what does it look like when you invest something like that?
So it's a good question. Everybody hear that. As an investor, how do I know what your thesis is? How often you do distributions? How long are you going to hold the property? Okay. And typically the way that this works is when you're putting together deals, you sort of have a presentation, which is at a high level going to spell that out, right? So we're apartment investors. This is a value add deal. We're going to hold this for 5 years. We expect these metrics on these deals. We're going to do quarterly distributions, but we're going to hold that for the first 6 months of the deal because we'll be renovating and cash flow will be low. So distributions will start on month 7 moving forward, right? All of that is going to be spelled out first and foremost in that offering memorandum. So if we're putting a deal together, we're going to put a presentation together that spells that out. Now from there, if you go, great, that sounds good. Now there's a whole other set of legal docs that really spell that out, okay? So a presentation is a presentation. People can say anything in that. If you say, that's great, here's my check, you're going to get a series of documents that's going to spell that out and you're going to understand that.
And then follow up on that, like how much of this presentation from a passive investor do you have to know? You said obviously trust in the guy you're investing with, like that makes sense. And then you also need to have some knowledge of the deal, like And that's a lot of stuff that
Yeah. Yeah.
I don't know.
I think the truthful answer is the more of this you know makes you a better investor, right? It's sort of like investing in a stock, right? So you typically, if you're going to put money in Amazon or whatever, you typically have a general idea of what they do, the direction they're going, right? So I think at the end of the day, the more of this you know, the better investor you are, right? So do you have to have massive depth in every category? That's again, how much time do you have to do it? What kind of investor are you? But I do think, and that was really honestly part of the presentation was to offer this framework for people, whether you're active or passive. You know, these are the things that you should be aware of, and these are the questions that you should ask the sponsor. So the short answer is the better you are at that, the better investor you are, right? You can see it coming. Good. Mr. Wazlewski, what do we have?
Acknowledge that I didn't heckle you, so.
Not yet. It's not over yet. It's not over yet.
As a passive investor,
Yes.
what liability or legal side, if I were to invest in one of your opportunities, would I have as a passive investor?
So
Meaning from building burns down, I know the insurance or any type of default or things like that, I can lose my investment.
Yeah.
But outside of that.
Yeah. So again, this is something where you have to look at the deal docs and you have to make sure that you understand it. So I can give you, again, there's no one way that people put deal packages together, but I can tell you the spirit of what people try to do, right? As a passive investor, your liability is your investment, okay? So, but again, read the documents, understand who you're doing, but if you put $250,000 in a passive investment and that building burns to the ground, you're only liable for your money. Maybe you are entitled to some insurance payout, right? So maybe a fire is a bad example. Let's use another example. You gave $250,000 to an investment and the deal sponsor defaulted on their loan. I think the question is, can they come after me to repay that loan?
Right.
No, they cannot. But again, read your deal docs, make sure that you understand it. But the spirit of passive investing, and again, there's bad actors everywhere on it. The spirit is that your liability is limited to your investment.
So as a passive, you're not participating in securing the loan.
No, you're not. So loan defaults, that's not good for the investment, but again, that doesn't affect you personally. Good questions.
And no
I
heckle.
like it. All right, anything else? Very good. Well, I want to thank everybody again for coming out. It was awesome. I know it's cold outside. Thank you. I'll stick around. I want to meet everybody.